Welcome. My name is John Rowland. I'm here today to talk to you guys about a naked put strategy. Barchart has been running these weekly webinars where we're showing you the different ways to use the tools and accessing the tools and strategies that are inside of the Barchart. Again, my name is John Rowland. I've been in the financial investment world for about 40 years, and what I try to do is I bring that knowledge to these webinars where I'm going to show you some of the insights, maybe we could call them trade secrets, to help you with these current strategies. Now, before we get started, I just want you to realize that I am not a financial advisor and that any strategies or discussions that we have today will be for educational purposes only, and that you as a trader need to make own assessments in terms of how you will assess risk and how you will look for investments, and don't take these as any kind of investment recommendations. So be aware of that as well. Okay, so yeah, again, welcome everyone. I want to say hi. Let me just have a quick check that you guys can see me. So just give me a quick check. Okay, great. Thanks guys. Yeah, so let's get started. So what if I said to you that, let me go here first. What if I said to you, here's a watch list that I created, and here's DraftKings, which has been one of the more active stocks of recent. And what if I said to you, who would feel comfortable purchasing this stock around $40, right? And I think a lot of us would look at this and say, yeah, I do feel comfortable purchasing this at $40. What if I told you that we could maybe purchase this at $40 and yet we could get a discount of about 75 to 80 cents? In other words, we would actually end up purchasing this at around $39.20. You know, everybody loves a discount. I certainly love a discount, and this is one of the ways we're going to use naked puts. Well, what if I told you just because you're willing to buy at $40, regardless if price returns to $40, you could earn 2% on your money based on your willingness, right? Our capital outlay in just 20 days. So what a naked put strategy will allow us to either discount a purchase or allow us to drive income. And so you can see that if within 22 days at a $40 strike, I could return close to 2% on my money. All right, so let's go and get into the meat and potatoes of this. All right, so what is our naked put strategy? Selling a naked put is an investment strategy that's very similar to our covered calls strategy. Naked put strategy allows you to sell a put of a stock that we don't own, hence naked, right? And you earn a premium income if that option expires worthless. The strategy is inherently a little bit more risky than a covered call strategy because in theory, you will be obligated to purchase the stock at the strike price. And in the worst case scenario, if the stock goes to zero, we would be out of that monies, right? But with proper risk management, we should never allow this to happen to us. So what I've done here is I pulled up the help section of the naked put strategy, which you can go in and look and see, the nuances of the naked put strategy. But I also wanted to show you guys here in tools under the free webinars. We did do a webinar a few weeks ago on covered calls. And so I would recommend to those of you who are interested in option strategies is to watch this one, because inside of that one, we really go into a lot more detail about the different inputs and columns that are inside of our strategy, all right? Inside of our option strategies. Okay. So let's go back to our put screener, right? And a lot of the inputs are going to be very similar to the ones that we see in the cover call strategy. And that's why I kind of recommend to you guys to go back to that. All right, so reading across the top, we have our symbol, we have our price, right? That's the most recent price, our strike price, our moneyness. Now, what moneyness means is how far is our strike from our current price, our last price. If I see a negative moneyness, that means my strike is below my last price. If I see a positive moneyness, that means my strike is above. For us, for our strategy, put strategies, we're going to look at strikes that are out of the money, below current price, or if I'm looking at acquisitions, I might look at ones that is near or at the money, all right? When I think about moneyness as a general rule, I want you to think about this percentage of, if I'm going to look for income, I want to look for income. I want to make sure that my moneyness is greater than 10% of. If I'm looking for an acquisition, I want to be inside of 10%, all right? And this is basically about how we look at price action of stocks. If you think about when a market makes a new high, technicians will tell you if price backs off, about 10%, that is a correction, right? So if I'm looking to purchase a stock in a correction phase, I want to make sure that I'm in that 10% correction. If I'm thinking about price backing off of a high and it moves, farther than 10%, I could actually be in a downtrend or a bear market. So we want to find strikes that are farther away from that 10%, where we don't think price is going to move down there, all right? So the strategy itself, we have to think about two different determinations of how we're going to pay for them. One is called cash secured, right? And so if I have a cash secured put, then the trader will be required to purchase that stock based on the strike price less the premium that they collect, that credit. And that's what we see here. Here is our bid. That would be what we would sell the strike for, and our break even. And our break even here is our strike price minus our bid price. But there are advanced strategies that are based on options, which we could have an account that is a margin account, right? And this would be depending upon your relationship with your broker and your account. Now, this is a little bit more an advanced strategy. And what I want you to understand is that the screener here is going to assume that we're going to be using a cash secured strategy. So we're not going to address the margin issue. But if I have a little time at the end, we'll look at maybe one margin example, right? Now, in a margin account, we will get greater leverage, and that greater leverage will allow us to have greater potential returns. Now, sometime in the future, I do believe that we will have a webinar where we will address the concepts of leverage and margin. All right. So the second part of our understanding of naked puts is really the strategy itself. Again, do I'm looking for income, or am I looking to lower my acquisition cost by ownership and getting something at a discount, all right? So now what I want to do is I'm going to start thinking about these first three components: my strike price, the credit that I'm going to get, the premium, and my break even. What I want to do now is I want to think about how these numbers line up, or how we design our trade is going to depend on a combination of our strike and our break even with structure, with our charts, right? With our swing lows, areas where I feel comfortable purchasing, or even outside factors like our trends, our moving averages. Some of you might use candlestick formations to find areas where you feel comfortable about making a purchase or going long. Or gaps is another great example of looking for trading opportunities. So we're going to look for those structures that are going to line up with our strike and our break even. So the first one we have here is Nokia, and you can see that the strike here is 1750, and we could have taken $3.30, and our break even is 14.20. Now, if I go to the chart and I look at Nokia, right? Well, this would not qualify, right? Because we talked about naked puts and cover calls. The strategies themselves are designed or more effective in markets that are in an uptrend or in a a sideways trend. This one you can see is definitely in a downtrend. So this would not be a good example for the strategy that we're going to do. Now, if I go down here, this is one of the ones I have been watching of recent. I see American Airlines, and I see a $10 strike, right? And I'm going to take in 87 cents per share, right? That's going to give me a break even of $9.13. So again, I'm going to go to that chart and look to see how those line up. So here's American Airlines up here. And I kind of prepped this earlier this morning. And I look at my strike and I look at my break even here, and I say to myself, first of all, what's my trend? Well, in this market, I think American Airlines, we could make a case for a very strong case for a market that is kind of in a sideways action, right? You know, certainly our current price is falling, right? The short-term trend is down, but over the last month or two, we've been in this kind of sideways action. We're at the lower end of this sideways action, right? So where's my strike? Well, my strike is back here. Where's my break even? My break even is here. Do I feel comfortable thinking that this would be an area where I would like to purchase American Airlines? Or if I'm looking for this as an income trade, and we'll go back to this in a second, do I feel that there is structure or elements that are going to keep price from reaching $10? And I do see, this recent swing low right here around 1070 that is still between me and my strike price. I see another swing low over here, 1030, that is between me and my strike price. And one of the nice things that I do like about this trade as an acquisition is there is this little teeny gap here, which would to me give me the belief that if price did come down to this strike, that this would definitely be one of the areas where I think price would reverse and go back up. So this trade is starting to look good in terms of structure and in terms of our strike price. Now think about our break even. If price went below here, right? This 916, 915, depending on how much we take in at the moment of that trade, that again seems like a very far distance in terms of price, and there's a lot of structure between me and that value. And if I was using good risk management, I probably would set a physical stop probably around $9.50. If price got below there, I'd probably be out of the trade. I would probably look to cover back that put and reassess that trade. But this would definitely be a trade that I would be looking at. All right, so let's go back and look at our statistics. So $10 strike, we're 87 cents of premium we're going to take in, and our break even is $9.13. All right, so the next thing we're going to look at is what is our expiration date. Here we see our expiration date on this one is 11 20, about 2 months ahead, a little bit less than 60 days, right? And that's going to be important for us as too. We're going to say how long is before my expiration, for my put becomes worthless. So all I want to say is, during the next 60 days, do I believe that American Airlines will stay above $9.13? So one of the things I can do to kind of get an idea of that is I can look and see what it's done over the last 60 days, or where has price been for the last 60 days or so. And here's our current price. And if I go back about 60 days, you can see that, you know, we are staying inside of that range that we talked about, that sideways range. And matter of fact, if I go all the way back to where my strike price is, where the structure of my strike price is, you know, that is 87 days ago. So it took a long time for American Airlines to go up, and now coming back. So this, again, in terms of length of time for my strike, this would work. Now, I know there's some of us, when we start talking about strike prices, we'll say something like, well, you know, I know in options that inside of 30 days, we'll see that the option will start to deteriorate or decay, right? That's the theta, and that's important for us. And yes, that's what we're going to do. Some of us will have learned how to trade weekly weekly expirations. And this one would probably be a monthly expiration. When we were in the covers call strategy, we talked about the difference between weeklies and monthlies. And one of the things that we believe is that monthly options tend to have more institutional traders, and those institutional traders are the ones that are going to pay for greater premiums. So when we look for picking strike expirations, we will lean towards monthlies. Now, doesn't mean that I can't look at weeklies. I'm just letting you know that in terms of liquidity, volume, open interest, and in premiums, you will find more advantageous to look at those monthly ones. All right. So we have about 60 days until that. And then the next thing I'm going to look at is over here is my potential rate of return. So on this trade, if I did this trade today, and for the next 60 days, price does not go below $9.13, then I'm going to make 9.5% return on my monies. Now that's a pretty good return and an option strategy for, you know, less than 60 days. One of the rules I'm going to use, a generality that I'm going to use when I make the determination of will I take this trade or not take this trade, is I'm going to look at my potential return on a 30-day basis, and I want to make sure that I get at least, and this would be for me, would be a deal breaker. I want to see a potential return of between 1 to 2% for every 30 days of commitment. So in this case, this would be 60 days, and we could see that we're getting close to about 4.7% return on our money over 60 days time. That is an important for me. And this would be a much better trade for me in terms of return on my investments. Now, how do we figure that out? Well, here is our break-even price and our value of our bid, 87 cents. So we take 87 cents and we divide it by the price that our break even, 1913, and times that by 100 to put it in to a percentage. And there it is, 9.5%. So this trade is starting to look really, really good. All right, in terms of time, in terms of structure, and in terms of reward on this trade. Okay. So our screener today now is giving us 119 different probabilities for us. Now I do see that when the screener is put out, it will do it based on our potential return. And you can see that that Nokia one, where the potential return is now 23%. Well, again, the reason why that potential return is so high is because this market is in a downtrend, and traders are buying put premiums, right? Because they feel that this market is going to go lower. And the only way we could get somebody to actually sell those is we have to make it attractive to them. Think about it like in terms like Vegas, right? When Vegas sets the line on a football game, right? If the home team is the favorite and everybody's betting on the home team, Vegas will continue to move the line and to attract bettors to bet on the visiting team. This is exactly what's happening in this scenario here. The returns are getting really, really high because we're not finding anybody who's willing to bet on that side. So that's why we're seeing we need to be careful with this when we look for these larger potential returns, because what we could be is stepping into a potential landmine or a stock that, because of its volatility, is going to have a big price movement in the opposite direction that we believe in our uptrend or our sideways trend, maybe a downwards trend. And so that's where our implied volatility is going to help us figure that out. Any market that is above 100% volatility is one that is very, very dangerous for us in this strategy because we are naked, remember? So we're going to modify this a little bit to help us a little bit. So one of the things I've done here is I've created a screener where I've change some of the variables inside of it, the screener. So let's look at those variables that I changed just a slightly, not too much. First thing I've done is I've changed the implied volatility from 50 to 100. I want to see volatility. Volatility is good for us because it's going to relate to higher premium prices, but I don't want too much volatility, right? So somewhere between 50 and 100% would be, again, this is a generality. It's not something that's set in stone. Could I find volatility of 105, 110, 120? Yeah, I could, but I got to narrow it down, right? 100 different put strategies to look at might be too many for me to look for. The second one here is stock price. Now, the reason why I use $50 is think about a stock that I'm going to purchase. I'm going to be required to put up that capital, right? That cash secured. So on a $50 stock, one option is 100 shares. 100 shares times $50 is $5,000. So what I'm really saying here is I'm willing to make an investment in a stock where I'm going to put up at risk, in theory, $5,000. If you feel like you are looking at trades where you can afford stocks that are $100 or greater, then that's fine. And again, margin will make this variable almost a mute point because we won't have to put up as much. But on a cash secured basis, I'm kind of using 5,000. And why do I use 5,000? Well, for a lot of the brokers that are out there, to be a bona fide day trader of stock, they require you to maintain $25,000. And so what we're really only using is 25% of our total equity if that was something that I was willing to do. The next is our expiration dates. Again, I want to look for expirations that are shorter, right? Times to expiration, 60 days or less. But again, I'm going to give myself a little bit of flexibility. So I've narrowed that field to between 15 and 75%, 75 days. And the other variable that I have is down here is my bid price. And I want to look for bid prices of 50 cents or greater. Now, again, why I will do this is because, I don't want to chase nickels and quarters. I want to look for, some greater rewards, right? Think about if I have a $50 stock and I take in 50 cents, that's 1%, right? That's kind of that threshold where allow me a potential return for that trade. So now what I've done is I'm now looking at the results, and here now I've narrowed that field of 116 or 19, I think it was, down to 16 stocks. So at this point here, I can get through these a lot quicker to make sure which ones that it will fall into the scenarios that I'm looking for as a trader. So again, I'll just go right to my flip charts, and here's that American Airlines. We just kind of looked at that one. What's this, Alaskan Airlines? Okay, so here's Alaskan Airlines. Again, a market that has been kind of in a sideways to uptrend, but now price is accelerating to the downside. Where would I feel comfortable purchasing Alaskan Airlines? Well, you know, this structure here, where you have all these lows that were kind of holding the market up, you know, that could be support for Alaskan Airlines. Where did the market break away from our last area? Well, it came in this region between $32 and $30.22. So now I've kind of zeroed in to where I want to look for a strike combination that will allow me to take this trade. I want to make sure I get enough reward on my monies, and now I'm also looking at my structure around $32. And if I look at this Alaskan airline, here we do see our strike is 32.50, right? Right there. And my break even is 31.65. So now what I'm seeing is that my break even is in that area where I feel more comfortable being long, or where I believe that if price falls down there, it's going to reverse. How much time? Well, this one is only until October 16th, which is about 22 days away. And I'm going to take in a potential on this one of 2.7%. That is still a pretty good return. Now, my moneyness, though, here is inside of 10%. So this is telling me that if I'm going to put this trade on, I have a higher probability of acquiring this stock. So if I don't really want to own Alaskan Airlines, I want to just try to drive income from them, this would be a cautionary tale for me. I might want to look for a strike of lower than that 32.50, maybe $30, for example, okay? Um, okay, so let's continue on. Here is Carnival, again, another market that looks very similar to our Alaskan Airlines. You know, these are travel industries, you know, they're all kind of doing the same thing. Now this one, you know, again, there is some structure between me, but this one I think really kind of looks like it's in a downtrend, or at least it's getting really low in our range of price. So this one, I think I might be a little bit more cautious, but where could I look for a potential entry? It looks like around 12.50, and maybe if I can pull in 75 to 80 cents, this might be a good trade. Let's see what the screener says. And yeah, 12.50, I'm only getting 50 cents on this one. But again, 4.9% return on 22 days, right? So the market is offering you a higher return because there's a little bit more risk inside of this one because of, you know, maybe we might see a surgence of COVID, all right? So let's skip down to this one, MU. And this is one I really been watching, and I want to go to this one and do a little bit of an analysis for you guys. Okay, Micron Technologies, right? Okay, so here is definitely a market that is now much more in an uptrend in the shorter period of time, but again, maybe sideways in a range of price, right? Where would I feel more comfortable taking on this trade, or where I would feel comfortable acquiring the stock? It looks to me somewhere around $45, right? The bottom of this most recent swing low that we have a nice gap up. Market came back and kind of held the most recent pivot swing high on this. And so this is definitely in an uptrend. Now, what I might do is take a moment and look at a higher time frame to see a much bigger picture. And again, you know, that entry is on the lower end of the range of price that we've seen over a longer period of time. And so again, I'm feeling more comfortable about that, right? $45. We've recently just bounced off of some resistance, impulse, make a new high, short-term high. Now we're getting that correction, right? So a correction from $51, $52, 10%, right, would be about $5.20, $6, right? And that $45 strike is inside of that 10% correction from my most recent uh, pivot or swing high. So that plays into our trade as well. Now, watch what happens when we go to this in the screener itself. Go back to my screener. Bear with me, my internet is a little slow today. I'm sure all of us have been experienced, right? Notice though, here we do have the $45 strike where we're going to take in $2.20 and we're going to set our break even at $42.78. That is definitely where we were looking at before. The other thing that I want to point out to you is that today, right, notice that we see our volume here, right, is 2,000 lots that have traded so far in the $45 strike. And the open interest of yesterday was only 1,000. So here we're seeing unusual options activity in at that strike value. People are buying this option. They're paying that premium. That's good for us. That's what we want. But let's look at this one. Here's the $40 strike, right? $40 strike. And both of these are going to give me some nice returns on my 60 days. The $40 strike is going to give me 2.4, and the $45 strike is going to give me a return of 5.2 over the next 57 days, all right? So again, let's go back to our chart, right? And what was it, $2.20? Yeah, so yeah, I'm going to get, right? I'm going to get a lot of protection, you know, based on that $45 strike. But remember, the other one was the $40 strike, which is way down here. I could get 2% return on my money. And do I fear price falling below $40 based on this chart? No, I don't. I don't. I think that this one would be a good trade setups either on an acquisition or in this case on income. And let's just kind of look at a comparison of how long a time, right? Here is our, where our most recent swing low is, 14 days. But if we go all the way back to this $40, you know, that is 123 days ago. So I feel comfortable knowing that there's a very low probability for us to see price fall back to $40. And the other thing that I like about today is that I see a surgence in volume, right? The relationship here, I've got 50% of my volume is represented inside of my option open interest. So this is telling me that this is an active strike as of today. So there's probably some premium in this market, okay? So the flip chart allows us to quickly survey our strike and break even combination in concert with our structure, right? This is another one that I've been kind of keeping an eye on. So let's walk through this one together. All right. So again, a market that's been kind of in a sideways action. We do see price is starting to fall. That's not always a bad thing. You know, we want to see kind of falling prices. That's going to add premium to our puts. But where would I feel comfortable being long this market? Well, again, somewhere. Oh, excuse me. This is American Airlines. Let's see, Nivea. I want to do. Yep. Apologize. All right. Uptrend, right? Nice uptrend here. Where will I feel comfortable being long this one, right? Around $35. So where would I be looking to set a stop? You know, probably, you know, down around 33.50 or a little bit below that, right? So what could I get out of this trade? Could I do a put strategy on this one, right? This is a much stronger uptrend. And here we go, $35 strike, right? Our moneyness is 18%. That's telling us that it's a lower probability that price is going to return. It's more of an income trade setup. I'm going to take in 90 cents, right? 90 cents. My break even is 34.10, and in 22 days, I could return 2.6% return on my money. So let's go back to our chart again. All right. So we said about 90 cents, right? And that trade kind of looks good to me. I feel comfortable there. I'm going to get a nice return on my money. And then in the next, long as price stays above here in the next 22 days, well, you know, it's been up here for almost a week or two. Yeah, your price could come back to here, but you know, this is where our trend is up, right? Let's look at some of the other things. Whoops. Um, some of the other things we might do is look at a trend line. Um, let me go back to a interactive chart where I can put some more strategies up there. Right, one of the ones that I like to look at and that Barchart uses to define a market, right? Here we can see that our 20-day moving average is moving up really nicely here, and my strike combination is below my 20-day moving average, which is telling me that, you know, probability says that price should stay equal or at least above this moving average. So again, I don't have that fear or probability of price going down into that that zone. All right. Okay, so I might like this trade. I might be watching this trade, so I could add it to my watch list. And whoops, my screen is a little. This is going to be an issue. Okay, excuse me. I can't access my watch list from here, but I could add it to my watch list. There's my put me in coach watch list, and there's my Micron, right? And so these are some of the ones that I've been watching over the last few days in preparation of our markets of our webinar. So here's one that I was kind of interested in is Pfizer. Again, you know, definitely in a sideways action, right? Are we pulling back? Yeah, we are. Are we correcting? What's our most recent high? Close to $40, 10%. That puts us around $36. So, we're in that correction stage. And, I do see a lot of little gaps and accelerations of price. So where would I feel comfortable doing this market, or where I would feel that would be a good entry value for me? Well, around $34 would be, I think, a good spot, right? $34. So I could go back to Pfizer. One of the what we can do is we can go through Pfizer to our interactive chart and then come down to our naked puts. Again, I like to look for monthlies, and at a $34 value on a October one, I'm only getting 36 cents. That would fall underneath my my threshold, but it's still 1%. Not great, but still 1%. But if I gave Pfizer a little bit more time, let's say into November, now I'm picking up $1.23 on a $34 strike, and my return is 3.8%, which is kind of nice. I like that as a trade. And why do I like that as a trade? Well, again, because structurally, there's a lot going on for me, right? This is where we have a swing low, right? This would be a target purchase area that I would feel comfortable with. We have a gap of an acceleration of price. And if I look at my range of price, we're in the bottom third. Again, something that I like to do when I do these strategies. My break even on this one, we have to check our prices again. I think I set this up this morning. $1.20, I think it was said, yeah, our break even would be right down here on the top of another area, which looks very desirable. And so one of the things we also could start to think about is some of these stocks that we're going to start trading will give us a dividend. Now, potentially, if we get exercise, if we are required to buy that. Now, remember, you only get the dividend if you own the stock. We're selling the put. We don't own that stock yet. But if somebody was going to exercise us, if price fell down into that 34 area and we got exercise, then we would have the opportunity to take in that dividend. Now, I'm not saying that that is going to happen, but you can see that the dividend on Pfizer is 38 cents per quarter, and our ex-dividend dividend distributions do fall inside. You can see 1108, 11.7 do fall inside of our expiration date. So there is an outside possibility that if we got exercised on this one in an area where I already feel comfortable purchasing it, I would also have an opportunity to pick up that dividend, which would even lower my acquisition price to about $34, excuse me, $32.42, right? Now, there's no guarantee that when price gets down to $34, that we are going to get exercised, right? Now, that will depend on what the value of the $34 put is when price gets there. If it's, 6 days from now, it's probably not going to be enough to exercise us. But if we are getting close to expiration or close to that ex-dividend, that could factor into that exercise, all right? Not something that will happen a lot, but it's something that I want you to be aware of. Okay, all right. All right, so we looked at this one. Here's Toll Brothers, right? Again, where would I feel comfortable on this one? This is a nice uptrending market. I don't know if any of you guys out there have tried to buy a house recently, but my daughter has been looking for a house in the North Carolina area, and it is crazy. The market is absolutely crazy. So home builders are doing well for themselves. So here's again a swing pivot low, where I would say that I don't think price is going to fall below around $40, right? Toll Brothers, naked puts, $40 strike. Doesn't work for me here, right? Not enough. If I go out to November, very strong uptrending stock, right? Don't have a $40 strike. Not to worry. Sometimes we don't see that strike price. We can always go to our options grid, and we do have a $40 strike where we're going to take in $1.15, right? So now we're going to have to do that math ourselves. So if we have a $40 strike, we take in $1.15. $40 minus $1.15. Our break even is $38.85. We're taking in $1.15. We'll divide it by our break even, $38.85, and times it by 100 to give us our percentage, just under 3%, or about 1.5 for every 30 days. So this would be one of those ones that would fall into that category. Okay. All right. All right. And the final one that I want to show you before we finish up today, let's go back to our watch list. Is this one, West Rock. Okay. And this one has been popping up on the screener for several days, and there was a lot of put premium being bought as prices were going up, which is kind of interesting. And notice today, price is in an area where we would have felt comfortable probably purchasing this stock. And if we look at this stock over a longer period of time, right, this is a very well-defined uptrend. We've just had, this breakout, right? This is ascending wedge. We just had this breakout impulse, and now we're having that correction in our market, right? We went from $40 down to $32. That's a big correction for a $30, $40 stock, but it's in that area where we would have felt comfortable, right? So we did get a question beforehand, the webinar from John from Texas, and how could we take this trade? Or let's say I'm willing to buy this at $32, but I'm already in the put strategy. So this is a difficult one to address, and John, I will send that to you at some point after our webinar. But at this point here, I would still just stay with the trade, stay with that put strategy trade, and let probability run out. Now, if I pull in $1.20 in revenue, what I could do is now I could say I'm willing to purchase this at $32.50 and maybe give away a little bit of that premium that I took in, like going to take in that $1.20. So now I actually would raise my entry value. Maybe I would be willing to buy it at $33, right? Take a little bit of that profit to allow me to purchase that one. Or I just wait to see if I get exercised on this one. Now, what might happen in here is we could bounce off of this value for a few days, and at some point somebody might actually exercise us if price got below $32. Now let's go and look at our options on this one. And again, you can see that on our monthly here, 32.50, a nice return on a trade. So John, you can still get paid to wait to see if it comes to $32. Yeah, there is that risk that it could come down to 32 and then run back away. But then you could use that premium, that $1.40 premium that you collected to raise your cost. In other words, I could go up to, let's say, $33.90 or $33.40 because my net cost would only be $32 where I was looking to purchase that one. All right. Okay. Now I know that I didn't pause and answer any questions to you guys. If you had any questions about some of the tools that we have inside of Barchart, or how I drew lines, or how I manipulated my charts, those ones you can send directly to support@barchart.com. If you have a question about any of the strategies that I presented here or the details of the strategy itself, send those questions as well. I didn't get a chance to look at the chat as we went along, but I will tell you that anybody who sent in a question today or put in your questions now, we will glean those out and I will address all of your questions. I will answer to you. Just give me a couple days to get through those questions. So if you do have a question that went unanswered, all right? Now, I do have a moment of time before we finish up here today. And we did talk about understanding that the screener here is based on a cash secured basis, but we did talk about margin and that was an advanced strategy. And that our potential return is based on that cash secured. So I do want to show you a tool that is available to you that is outside of Barchart. And this is at the CBOE, the Chicago Board of Options Exchange. In their tools and resources, they have something called the margin calculator. This is how they determine the margin. Now, your broker might have different rules depending on your accounts, depending on what they feel comfortable. They can charge you more margin, but they can't charge less. And there are two ways that the exchange looks at the margin. And I think the trade that I did was, well, let's do one together. Let's go back to my $45. I think that was the, let me just check. Which one is trade? Okay. I think it was this one. Well, we can do one together. Oh, let's do Snap. Let's see what's going on with Snap. Okay. Interesting. All right. Very popular stock right now, internet stock, right? Where do I feel comfortable in this one, right? A nice swing low here, just below $22. Another swing low here at $23, right? Let's see, $23. Okay, 22 days, we get 3%. All right, so $23 strike, we're going to take in 67 cents, right? And our current price is $24.48. We're going to do one contract. We're going to expire in October. Our strike price is $23. What did we say we're going to take in? We're going to take in 67 cents. And our current price was, I believe, $24.40. Calculate. And according to the exchange, right, we're going to take in 67 cents. Our strike price is at $23, right? The underlying stock is at $24.40. Our margin requirement on this one would be $415, right? We're going to take in $67. Get out our calculator. $67 divided by 415 times by our 100. If I was using margin, I had a margin account available to me, this option strategy would return a potential 16% in 22 days and not the 3% that we would get on a cash secure. Okay, so there's a little tool for you guys out there to look for to help you with do that math. All right, so I see that our time is running out. I hope that you guys enjoyed this presentation. Again, remember that it's more effective in markets that are in a sideways or uptrending. We can use it for trying to create income or looking for ways to acquire a stock at a discounted price. Remember to look at your strike and break even combination as it relates to your charts in terms of your trend, your structures, things that you believe in as a trader, and that there's the risk that we have is that in theory, our stock price could still go down and we could get run over by volatility. So we want to make sure that we want to find markets that have some volatility, but not extreme volatility. So I always like to end with the caveat. And here's the caveat for you guys. All right. This one was the premiums were really, really juicy. Volatility was running around 200%. And the rate of returns were in the 10, 15, 20% as this stock was rallying. The puts were still going up. They were even going up higher. And what happened was that this drug company, one of their drugs did not pass the scrutiny of the FDA, and boom, volatility would have run you over. This little steamroller, I don't know, you guys like my little steamroller here? The steamroller of volatility. So be careful with high volatility markets in naked put strategies. Use those higher volatility ones for markets where you're using credit or debit spreads. But in this one, you would have been really run over by that steamroller. So be careful with that. And so with that, I wish you all the best of all trading and stick around, come back next week. We're going to do a discussion about gaps. And gaps are a very powerful story. I'll give you a little preview. Right? Learning how to use gaps to find trade entries and the story that the gaps are telling us. And so join me next week on Wednesday, September 30th. There it is. Right, sign up for that webinar Wednesday of September 30th. Come and join me for that, and I think you will enjoy that one as well. Until then, I wish you all the best, and good night.